Can you see the slides on the income approach?
Yes, yes, sir. I
Okay.
just request to all the participants, please turn on your cameras. Please start your session, sir. Thank you so much.
Okay. So, uh, is everyone back from lunch? Are all of you back? And is most of the people back from lunch, right? Okay. So, yesterday we had covered the cost approach. So today, we are going to look at one other major approach, which is the income approach. So in this approach, basically the valuation is based on the income capability of the asset, right? So there are about largely two approaches here. One is called the capitalization earnings approach, and the other is the method. I mean, there are two methods in this. There's a DCF, a discounted cash flow method, and there is a capitalization earnings method. So the premise of this method is that the valuation of the asset should be based on the income generating capability of the asset, right? So yesterday we had looked at the cost approach where we were trying to calculate the replacement cost new of the asset, and then you discount it, but you depreciate it with all sorts of depreciation that are possible, and then you calculate the current the valuation of the asset. In this, we will take the remaining life assets remaining life income generation uh, flows, and we will try and compute the present value of that. So the point at which you're doing the valuation, you basically look at the present value of all the cash flows that will be generated by the asset, right? So if to give you a very simple example, if you sort of have a property which is which is given on rent, then the rent that is going to accrue to you over the life of the property is actually the income, is actually the valuation of the property, right? I mean, it's a sort of a no-brainer, right? So the basics of the income approach are that is established on the theory that the knowledgeable investor will base the investment decision on the expected returns or the cash flows generated by the property or business. Very clearly, I mean, this is a simple, premise in which. So when it does that, when you apply this approach, you consider all the possible assets, which are used to operate the facility, the land and the building and the process units or machinery and equipment, all sorts of assets that are a part of which will help you in generating the asset, right? Uh, I mentioned to you about the capitalization earnings approach. The capitalization earnings approach is a simple approach in income valuation and is based on the capitalization rate. Now, the capitalization rate is has a relationship between the earnings of the asset and the value of the asset, and the cost of the earnings of the asset is based on the cost of the cost that you have sort of incur in in sort of servicing the debt of the on the asset, and the equity investors' expectations minus minus from the net cash flow expectation of the equity investor, right? So basically, the equity investors' expectations are based on the risk and the availability of financing in current market conditions. The debt is basically, debt servicing is obviously based on the availability of financing, the risk, and the current market conditions, and so is the equity investors' cost of financing, right? We will cover this in more detail as we go along in this consider this approach. So in the income approach, so basically what you're doing is you're taking the future monetary benefits of which are based on the typical asset over the economic life of the asset, considering all the future market conditions, and you are discounting it to compute the present value as of the date of valuation, right? So you have flow 1 coming in year 1, flow 2 coming in year 2, flow 3 coming in year 3. So you discount them with a factor which helps you in sort of in calculating what the present value of the So what is this principle? So this is called the time value of money. I don't know how many of you are really familiar with the time value of money, but this is, I'll just stop here for a second and I'll go back to all of you for a second, just to find out from you people as to how many of you are familiar with the time value of money. So this is a very fundamental, concept in the income method. So what it really is saying is, what the time value of money says is that the 100 rupees which I invested today is not worth 100 rupees tomorrow. It's worth, it's worth much more, because you expect a certain rate of return. Or let's say the 100 rupees that you receive 5 years later is not equal to 100 rupees today. So to give you a more sort of clear example of this, so if you were to be told by somebody that, look, I'll give you 100 rupees 5 years later, and if somebody was to pull out a 100 rupees note today and give it to you, obviously this is the difference between the two. There is a time value of money, and that is the elementary principle on which the income method is supposed to be based, right? So this is how this is a very primary method which the buyers and sellers use to make an investment decision. So they compute the present value of the cash flows that are accruing on the asset, arising from the asset, and they are discounting it by a factor which is a sort of composite rate of return, which covers both the types of risks. Both one is that the investment that you're making today of 100 rupees is actually has to be paid back at some point of time, and along with a certain reward. So it's that return should be a composite of the return that you get on the taking care of all the risks, etc., that you are taking at that point of time to invest that 100 rupees, right? So the time value of money, basically, this has certain, the nomenclature is basically comprises of present value, future value, and discounting, right? If you were to get 100 rupees every year for the next 10 years, so you can compute, okay, that if you were to get 100 rupees every year, right? So if you were to calculate the value of that 100 rupees for 10 years that you get each year today, then you will obviously have to, the denominator for that kind of money would be the discounting factor, which will help you in calculating the present value of the money, right? So I will just take you to a slide which is okay. So skip this. So, okay, so here if you look at this future value equation which is given on this slide, so it says that the future value today of let's say that you have the rate of the interest rate is I, okay, for the money that is being invested today, right? And you have to calculate over the n periods what is the future value going to be after n periods. Then the present value into 1 plus I raised to the power n is actually the future value of the money, right? I is the interest rate here, and present value is let's say present value is 100 rupees and the interest is 10 rupees. Then you will invest it for, let's say, 10 periods. So that's the compounding that is happening. So the future value you can compute on the basis of this equation. And to give you an example, 100 rupees invested at 12% rate of return in 5 years would fetch you 176 rupees. So if you were to calculate the 1 plus I equation over 5 years, then you would get 176 is the future value of money. You can calculate it and try and see what value you get. Similarly, if you were to calculate the present value of some cash that you receive 5 years later, right, is equal to the equation that is given here, that if somebody gave you 100 rupees after 5 years, then what is it worth today? Then that if the interest or let's say that factor I you may call it interest rate or you may call it whatever, but it's some rate of return that the investor is expecting. Then that that value is that comes in the denominator. I mean, 1 plus I raised to the power n will be in the denominator. So that is called the present value of the that's how you compute the present value of the money that is cash that is promised to you after 5 years. The value of that today is equal to 1 upon multiplied by 1 upon 1 plus I raised to the power n. So this is the the broad equation that you will apply. I'll skip present value of annuity, but this is not relevant to you right now. But if you are considering depreciation reserves and all that, then you may have to consider this. Now, so what is the there is something known as a discount rate, right? So the I that you found in the equation. So when somebody is investing 100 rupees today, and he is expecting a cash flow from that 100 rupees for, let's say, 10 years, and he wants to know, okay, that if he knows the expected cash flows for the next 10 years, let's say it's 10 rupees each, right? So he wants to know the present value of those benefits in the year that he's investing 100 rupees. Then that factor by which it is being it's being sort of divided, or let's say in the denominator, the 1 plus I, the I factor, is known as a discount factor, right? And that is a number that is basically an expected rate of return for that investor, which is based on the on the expectation of the risk, the type of asset that he is that he is, the overall macroeconomic condition, the availability of financing, etc. So that is the that is the discount rate that you will use to calculate the time value of to calculate the present value of the flows that are coming through. So this is slightly this may be new for some people. So if you are having any problem in sort of understanding it, then I can broadly explain to you. I don't have a whiteboard on this, but I can try and explain to any person if he is facing any issues with this concept to begin with. So this is a very fundamental concept in income method, which you ought to figure out before we step any further, right? So is there any question on this discount rate or the expected rate of return that an investor is expecting?
Sir,
So
can you please explain it once again, sir?
Okay.
Just not catch it up.
So see, you have you are investing, let's say, 1 crore rupees in a asset, right? Let's say a property, right? And you're expecting 1 lakh rupees rental every month, right? And the life of the asset, let's say, is about 40 years, right? Now you want to know what is the present value of these, and you're expecting that there is generally zero risk. So let's assume that there is a zero risk in not renting out that property. So let's say that you are assured that the property will be rented out for the next 40 years at the rate of 1 lakh rupees constant. Let's assume a hypothetical case. Now, this is not a real case. In the real scenario, there will be some growth in the cash flow the rent that you expect every year. But you may expect 1 lakh in the first year, 1 lakh 10,000 in the second year, and so on. But for the sake of fundamentally understanding this, let's assume that it's constant 1 lakh rupees for the next 40 years. Now, obviously, you would like to know what is now that 1 lakh that you're getting in the 20th year is not the same as the money that you're getting in the first year. That you're getting much later by that time, there will be an inflation risk, there will be a currency risk, there will be macroeconomic risks, there may be new regulation that may come in. So there is some kind of a risk on your investment, right? Your property may undergo you may have a fire risk, so many things, right? I mean, unknown factors can. So there is some reward that you expect against that risk. But as the risk grows, the reward should be more, right? If you are if your risk is higher, the reward has to be higher, right? That is a general principle in investment. So now we are considering a property investment, which is considered as a low risk investment, right? Generally, right? But let's take that you're investing in a new business, so that may have a high risk of return, right? You may be undergoing some high risk. The product can fail. The product can have a competition. So there is the people who invest in equity and the people who say debt people, the people who are sort of giving you debt, they have a fixed rate of return in their head, right? I mean, there is a they have the first right of sort of they can have a charge in the asset. So there is a lower risk as compared to the equity. Equity has a higher risk. So people who invest in equity basically expect higher return as compared to debt. Debt is generally lower expectation of return in debt as compared to equity, right? So when you're investing that money, you expect a certain rate of return, and that rate of return is called the discounted rate, the discounting rate, right? Now that may vary from the type of investment it is. Suppose you're investing in a completely new technology, your rate of return expectation may be much higher, because that technology can fail. The technology can go for a 6. It can it may become a very big success also. So people, I mean, depending on the investment type, and not the investor but the investment, the asset, the market economy that you are sort of dealing with, whether you're in India or in US, those kind of things will matter, right? So these are generally what govern the discounted rate, and there is an industry risk and there is a market risk, right? So both are separated. Now we will not go into the detail of how do you get to the discount rate. That is generally not, that is not going to be scope of my discussion today, but that is there are books that are written on this, which which cover all sorts of risk, and there's a risk-free rate of return, and there is a there is a market risk, and there is an asset risk, and there is those different risks that are premiums that you expect on the asset. So that is generally the fundamental behind this, right? So again, to recapitulate, I mean, you are basically computing the value, you're doing the valuation based on income. Now income will flow over number of years, 30 years, 40 years, 20 years, right? Those cash flows have to be discounted, right? And there's going to be some growth. There is going to be a rate of growth for the industry. There may be a negative rate of growth also. So all those factors will have to be considered. So therefore, we'll come to the concept of what is called capitalization rate also. Now, capitalization earnings method is one method of calculating the valuation of the value of an asset, right? What in capitalization rate, what it does is that it basically, you take the rate of growth and you take the discount rate. You minus the rate of growth from the discount rate, and that is called your capitalization rate. And we will see how we'll use this capitalization rate to come to the value of the asset, right? Or value of the on the basis of income, right? So it basically gives you a very simple method of calculating, let's say the value, right, of the asset using the income method, right? So the income upon the asset you paid, let's say you paid let's say you invested 10 lakh rupees, right? And you're getting a income of let's say 1 lakh rupees a month, right? So here what we are doing is that the income projection upon the capitalization rate is equal to the income value, right? The value of the asset. So your income projection is 1 lakh rupees, and let's say that the discounting rate was 12% and you had a 4% rate of growth every year. So 12 minus 4, that will become your denominator, which will be the capitalization rate, and you will be able to get the income value of the asset. So you got a 10 lakh rupee asset, 10 lakh rupee you invested, and you have, a flow of income of 1 lakh rupees per year, but at the rate of growth of 4%, and your discounting rate is, let's say, 12%. The return that you expect is, let's say, 12%. Then 12 minus 4 is, whatever, 0.08. 1 lakh upon 0.08 will be your income, valuation. That is a fundamental capitalization earnings method. Now here you just have to remember that you're taking the next period's net cash flow. Okay, so the concept here is that the capitalization rate is actually in the denominator. The net cash flow in the numerator is basically the normalized cash flow expected in the period immediately following the valuation date. So it's not NCF of the period prior to this thing, but the period ahead of valuation date. So let's say that you're doing 1st January, 31st December as the valuation date, then 1st January to the 31st December of the next year will be the net cash flow that you expect upon the capitalization rate will become the present value of the income value of the asset. So this is basically the capitalization earnings method of calculating income. So let me just stop here for a second and let me just go back to these are like concepts that you need to grasp a little bit. So I'll just break here. Any questions around this capitalization earnings method? So we are taking, again to recapture, we are taking the next period's net cash flow and we will define what net cash flows are. And we are dividing that by the capitalization rate, not the discount rate. Discount rate minus the rate of growth of the cash flows every year.
Sir, is it same? Hello?
Yes, sir.
Is it the same like project investment where they do all this internal rate of return and the net value, present NPV, all this stuff?
So those also we will cover. That's a discounted cash flow method. This is a very simple income upon capitalization rate, capitalization earnings method for calculating the present value. So the assumption here is that there's a constant growth for perpetuity, that there is that it'll forever earn 1 lakh rupees for you, right? Forever. There'll be some rate of growth of 4%, constant rate of growth until perpetuity. And that your rate of return, discount rate of return is so and so. So these are the assumptions in this model. Why it is close to the present value of why it's very close to the discounted cash flow method, both will converge. The reason being that the cash flows that follow after 15-20 years have literally no value. So even if there is an assumption of perpetuity, there is very little error in this. So I hope you understand what I'm saying. If you look at the 1 plus I factor in the denominator, as we had covered earlier, if you went back to the previous slides, then, just to recapture this thing, that formula that we were considering here. See, if you look at this, now I'm calculating let's look at the present value. That let's say 1 lakh rupees after 20th year will be 1 lakh divided by 1 plus I raised to the power n. N is 20 years, right? So it's it's going to be literally of no value, right? So that's why there is very little error in assuming that the cash flows are coming in for perpetually. I hope you're able to grasp this point. This is, I hope I'm explaining it well enough for you people to understand. So if I'm not able to explain it well, please ask me the question and maybe I can understand your doubts.
So some examples can be shown.
Yes, sir. See, again, so let us say that you've invested 1 crore की property में, right? उसके ऊपर आपको 1 लाख रुपए रिटर्न आ रहा है एवरी ईयर, और उसका 4% आपका लीज में आपने दे दिया परपेचुअली, और आपने 4% पे ग्रोथ मिलेगा आपको लीज रेंट में, तो आपका एक्सपेक्टेशन है 12% रेट ऑफ रिटर्न का, ठीक है? डिस्काउंट रेट आपका 12% हो गया, तो आपका 1 लाख रुपए अपॉन 12% minus 4% in the denominator, so it is equal to 0.08, if you do that, you will get something like, I think 1 crore 25 lakhs or something like that, right? I can do the calculation here on my, quick on my this thing. So that is the value of this asset. Aapne invest kiya 1 crore, right? So if anybody can do it for me, I can. It is 12 and a half lakhs. 1 second. 12 1 lakh to 1 second. Lakh divided by 0.08. So that into 100, I think that it will be 200. So it will be 1.25 crores, right? So you're taking 12% as a percentage, right? So the 100 will appear in the in the numerator. The calculation will be close to about 1 crore and 25 lakhs. So that is that is generally that is the concept in capitalization earning. That is an example I can give you offhand right now, but we will do an example if you want later on in this thing. There is a slide on which there is one example that we can all do if you want, which is taken after 2-3 slides. I can come to that example also, right? But conceptually, do you people understand this capitalization earnings principle? Okay, if anybody has any question, please go ahead and ask again, because I will then push on to Gordon growth model, which is any questions, sir, on this? Please ask. So normalize, see, the other thing that you need to keep in mind is the normalized cash flows have to take out whatever additional capital investments are there, right? So suppose you've invested 1 crore in the property, but your property needs some refurbishing after 10 years. Those additional capital investments have to be taken out of that. Any excess working capital that you need to generate to maintain that growth also has to be accounted for. So the net normalized cash flow concept is that the normalized net cash flow expected in the period immediately following the valuation date. Now, that the normalized cash flow means that you're taking out additional capital expenditures and any additional net working capital needed to realize the projected future revenues, right? So those have to be taken out. So this is another adjustment that you need to do in the normalized net cash flow. So the assumption here is, again repeated, it's for perpetuity. So you are expecting a constant rate of growth until perpetuity, right? That is what is. And cash flows obviously have very low value as we go along. After 20 years, they have literally no value, right? So that is another thing that you need to understand about this, right? So again, it repeats here in this slide. The net cash flow to capitalize has to subtract investments such as capital expenditures and additional net working capital needed to realize the projected future revenues and expenses of the existing business. So this is again one of the fundamental, The next one, which is based on the capitalization earnings principle, is called the Gordon growth model. Now here, see, in the capitalization earning, this thing, you're taking the year after, the period after the valuation date. But here we take the same period as that in the valuation date. So in the Gordon growth model, you have the net cash flow in the year in which you're doing valuation, right? The year prior to the the year which is in the valuation period itself, right? So let's say the valuation date is 31st December 2015, that you're taking, let's say, the year Jan 1st to December 31st, 2015, the net cash flow of that year, right? So it's a 0 years cash flow, and you take the growth 1 plus G in the numerator, right? So you multiply that by the growth that was taken in the capitalization earnings only in the denominator now also has a also you add it, you take 1 plus G in the numerator itself. So the net cash flow in the 0 year is basically multiplied by 1 plus G and then divided by K minus G. K is a discount rate and G is the growth. So this is the basic difference between the Gordon growth model and the capitalization earnings. Is basically fundamentally the concepts are the same. Are you people understanding this? Please kindly come forth. If you're not understanding this, this is very basic, right?
Sir, it looks it is completely a CS per you.
Sorry?
It looks it is completely CS per you. So how the valuer is going to
CS meaning?
it?
Sorry, CS.
Chartered accountants.
No, sir. So see, please try and understand, sir. The valuers, even plant and machinery valuers have to apply income method, right? And one of the simplest method that you can apply is the capitalization earnings method. Please understand that you have to see when you do the replacement cost of an asset and you apply the cost method, you have to check it out with your income, right? Whether it has the income potential or not. So don't think it's only for chartered accountants. It's for you. You have to apply it. There's no escape from this, You may need somebody who's good at Excel sheet and all that, as if you try and do a discounted cash flow. And even I use that, right? But fundamentally, you need to understand these concepts, right? The time value of money, the rate of growth of the business earnings, the discount rate, what basically is the discount rate?
Sir, what is the difference between salvage value and residual value?
Sorry? What is the difference between?
Salvage value.
Talking about that today, na? Let's talk about the income. Let's talk about the problem at hand right now, capitalization earnings. Na? Let's talk about that. Gordon growth model. Let's not talk about salvage value today. Na? We were talking about it yesterday, cost method, right? We'll come to that at the end if you want. Let's talk about the income method today.
Okay.
Please try and understand this. Otherwise, you'll have a problem in your exams. I mean, I'm not making
all going over the head, sir.
Wrong picture, but you will be. I don't want to skip to the two-stage model so quickly until you have grasped this, fundamentally. How many of you, except I only saw one hand when you talk about time value of money. How many other people are familiar with time value of money?
Also me, sir.
Okay, so you would be able to understand this by now.
Yeah, I am
Yes,
able to understand. Sir.
You should be able to understand it because this is all about time value of money. So those who are not, I would suggest that you go through some notes on time value of money, right? Fundamentally what I explained to you in the first few slides is what you need to understand more clearly as to why. So there is a stream of cash flows that you need to. Your stream of cash flows coming for 20 years. What is the value of it on the day that you're investing? So आपने 1 लाख रुपए इन्वेस्ट किया, उसके अगेंस्ट आपको 100 रुपए आया 20 साल के लिए, उसकी क्या वैल्यू है आज? That is what you need to understand. That is called the time value of money, right? And based on your investment, you will expect a return based on that, right? Higher the risk, the higher the rate of return should be. The lower the risk, lower the rate of return would be. Debt has lower return, low expectation of return as compared to equity. So equity is the last priority, as you know, in any liquidation matter also or anything. So equity को सबसे end में कुछ बचेगा तो मिलेगा, right? So equity can be eroded by losses. So debt has to be paid back because it can be secured. So in that sense, debt has lower risk as compared to equity. So these are some of the fundamental things that you need to understand. So I will push along, sir. If there's nobody is asking any questions, I have to then move on to
Sir,
the
it's all going above the head, sir. Detail में पढ़ना पड़ेगा पहले.
Okay. I suppose so. Then I think you'll have to. Some of you will have to read it.
Yeah,
Some of you
sir.
will have to
You have to
read about
read it with concentration.
Yeah. Some of you
Then
may have to read it more carefully. So anyway, so I'll again try to explain this Gordon growth model. Okay. Net cash flow of the base year in which you're doing the valuation is considered in Gordon growth model. The growth of the business, let's say, is 4%. The rate of return, that the discount rate is 12%. So denominator में K minus G मतलब discount factor minus discount rate minus rate of growth आ जाएगा. Cash flow ऊपर आएगा net cash flow, right? Which is your net cash flow after all the investments have been considered, right? That's your base year's cash flow, right? A net cash flow means after all the costs have been incurred. Okay, after all the expenses have been incurred, the net cash flow, okay, that is what is considered here. In the two-stage model, so what they do is that there are discrete cash flows for, let's say, X number of years, but then there is a rate of constant growth in till perpetuity after that. So there are two periods in that, right? There is period one in which for X years, for which there are discrete cash flows in year one, discrete in two, discrete in three, discrete in four. X number of years that there are discrete cash flows, right? So that you calculate the present value of those discrete cash flows for the year in which you're doing the valuation, right? So you get the present value of those discrete cash flows. For the remaining, you will apply, this formula, which is NCFN, which is 1 plus G upon K minus G divided by 1 plus K raised to power N, right? So this is to get the terminal value of the cash flows at the end of the X years for the perpetual period, for till perpetuity after that. That gives you the terminal value of the cash flows after that. So there are two periods in this. There is a discrete cash flow period कि आपको 1 लाख रुपए फर्स्ट ईयर में आएगा, सेकेंड ईयर में 2 लाख आएगा, तीसरे ईयर में 2.5 लाख आएगा, ऐसे till X number of years. And then there is a constant cash flow for you with a certain rate of growth after the X number of years. So that is you will calculate the value of this terminal cash flow by using this formula, NCFN in the numerator multiplied by 1 plus G upon K minus G divided by 1 plus K raised to power N. So that is the terminal value of the cash flow. Terminal cash flow present value can be computed on the basis of this, right? So I will skip any more complexity in this. So I think I probably have introduced more complexity than you may have wanted to confront in this.
Sir, I have a question.
Yes, sir.
Hello. Yes, I have a question.
Right, which is, sir?
In case we are done with this course, and then some of us will definitely qualify and become IBBI registered valuers. Right. As a plant and machinery valuer, how this methodology of income approach? I feel this income approach is suitable. Yeah. When you go for the business valuation of an enterprise. So how for a plant and machinery valuer, this will be helpful in organizing things for carrying out the valuation of plant and machinery and
Sir, I
other
explained to
assets.
you yesterday.
Because
I explained to you, sir, one second, sir, I've heard you, sir. Let me not, don't be confused about this. I explained to you yesterday that the replacement, what did I tell you yesterday about the cost method? It is subject to profitability. The depreciated replacement cost, which is the valuation based on the cost methodology, is subject to income capability, the profitability of the asset, right? तो इससे आपको क्या पता चलता है? आप बताइए मेरे को. You tell me, sir, what do you understand from this? When I said that yesterday, what did you understand from this?
So I feel that for plant and machinery valuation,
Sir,
if it is a fixed asset
sir,
base,
1 second, sir. Please understand. Please try and understand. Let's get this very clear. What did you understand from that concept? When I said it is subject to profitability, what did you understand from it?
the subject to profitability is a future based on the future, the certain factors,
That is it.
environmental factors, technology, and all factors will be.
Sorry, sir. Sorry. What? Don't confuse, sir. Please. Can somebody else please explain? Come forward and explain this. What do you understand from DRC is subject to profitability? Can somebody please step forward and explain in the class?
Is it time value of money we have to see?
Sir, please, 1 second. Let's not talk about time value. Well, let's talk about the fundamental concept of valuation. Your depreciated replacement cost is subject to profitability. What do you understand from this?
Sir, there can be difference between both the methods. So we have for justifying that cost method.
No,
It
sir.
should generate income, sir, actually.
Exactly. If there is no income of the asset, the value is zero, no? If the asset is not going to generate, it has only scrap value, right? So, अब आप बताइए कि when I say it's subject to profitability, what does that mean? It means that the asset has a profit earning capability. Now, how do you compute the value of the profit earning capability of the asset? That is what is the income of
generations and discounting at the. Yeah, that is what I am saying. That do we have as a plant and machinery valuer to apply both the approaches? One is the physical asset based on.
बताइए सर, आपको क्या समझ में आया सर? फिर आपको क्या समझ में आया? अगर आपको depreciated replacement cost मैंने बोला ना कल, is subject to assets income generating capability, right?
Yes.
So then what does it mean? You may compute 250 crores as a depreciated replacement cost of the asset, right? Suppose the income generating capability of the asset is only 100 crores. What are you going to do? How are you going to value it at 250 crores? You won't be able to do it, no, because the value of the asset will be 100 crores, right? So how do you derive 100 crores? That is the capitalization earnings method and the DCF method that I'm trying to teach you today. Please don't resist that. If you resist it, you'll be in deep trouble. I'm telling you. You will be valuing things wrong if you do that. I mean, I'm now, I'm one of you guys. Please, I'm not in any way better than you people. I'm trying to influence you to think clearly about this. Okay.
True, sir. True.
Please bear with me.
I'm trying to grasp
younger to some of
above the
you.
head.
I'm probably older than some of you, but please try and understand that DRC is subject to assets profitability. आप ये बांध लीजिए, right? Please try it as a knot and remember. Don't just value an asset on the basis of depreciated replacement cost, because you may be overvaluing the asset, right? Neither undervaluation करना है nor overvaluation करना है, right?
So you mean, which I understand now, that comparison between both approaches then.
Absolutely, sir. It has to converge. I mean, you have to make them converge as far as possible, and you have to get the right.
That exactly was my question. That exactly was my question, to understand, do we have to, how it is going to benefit us? You have rightly said that
that's how it's going to benefit.
Thank you very much.
Now I hope you understand. It's going to benefit you. If you don't understand this, you're going to be making mistakes in your valuation, right? If
Okay,
you take
okay, thank
asset, if you take only asset valuation of, I'm sorry, this is, yeah, one second. Let me just fix it. So I'm saying if you take only the asset valuation of a power plant today, I explained to you yesterday, sir, if you take the asset valuation of power plant based on the cost approach method, you will get a much higher valuation. Power load factors are only 50% for the remaining 20 years of its life. Coal-fired power plants are being run in competition against solar-fired, solar plants and windmills and hydroelectric power plants. What's going to happen? You have to take into consideration the income value of the valuation based on income. And there are only two methods in income valuation: capitalization earnings method and the DCF method. I am currently talking about capitalization earnings method, right? उसमें दो फंडामेंटल कॉन्सेप्ट है, आप बेस ईयर में ले लीजिए या बेस ईयर का नेक्स्ट पीरियड ले लीजिए. नेक्स्ट पीरियड लेंगे तो इट इज नेट कैश फ्लो ऑफ द नेक्स्ट ईयर डिवाइडेड बाय के माइनस जी. अगर आप बेस ईयर लेंगे तो नेट कैश फ्लो ऑफ द बेस ईयर 1 प्लस जी इन द न्यूमरेटर डिवाइडेड बाय के माइनस जी इन द डिनोमिनेटर. नेट कैश फ्लो मैंने बता दिया, इट हैज टू take away all the excess capital that is needed to meet the future growth, excess working capital that is required. I mean, I'm sorry I'm belaboring on this, but I found that, I'm finding that there is some, like if there is a resistance to this, please get it out of your head. You have to understand this income method. You just cannot escape it, right? So you have to learn this.
Yes. There is no resistance. Just wanted to get clarification from my side.
Okay.
Thank you very much.
Right.
We got understood the importance of it, but the things are not getting into the head.
Okay. So things are not simple to you right now because some of you are not familiar with the time value of money concept, right?
Right, sir. Right.
ये बहुत fundamental concept है cash flows का. That आज कल में जो 200 रुपए आएगा वो आज के 100 रुपए के बराबर हो सकता है, राइट? जस्ट theoretically 200 रुपए जो आपको 5 साल के बाद में मिलेगा may be equivalent to only 100 rupees today. That is the time value of money. It is in finance is called time value of money. Cash flows of each year are therefore discounted by a rate of return, and there is some effect of the number of periods. Which period are you talking about? Suppose the second year, third year, fourth year, उसके हिसाब से डिनोमिनेटर में वो 1 plus r square हो जाता है, right? Bracket square, okay? So that is what it means. तो एक बहुत ही फंडामेंटल सा मैथ्स का कॉन्सेप्ट है, ये फाइनेंस का कॉन्सेप्ट है अरिथमेटिकली. Okay, so this
we will have to understand it deeply, sir.
Right. You'll have to, yeah, I certainly agree with you that you'll have to understand this. So here is an example that I have given you. I've also repeated the same question in the form of question also in the question answer sheet. So basically, so the formula for the terminal value. So I discussed with you a little while back about this two-stage model, right? About the two-stage model in which there are two periods. See, cash flow में दो possibilities हो सकती हैं कि आपको discrete cash flows आ रहे हैं year 1, year 2, year 3, year 4, year 5 में शुरुआत की बात है, इन्वेस्टमेंट हो रही है, तो आपका एक constant growth अभी achieve नहीं हुआ है, right? That's the theory behind it. There is a discrete cash flow from year 1 to year 5. उसके बाद में you assume that there is a constant rate of growth till perpetuity. क्योंकि बिजनेस बैठ गया है, बिजनेस मतलब चल गया है, अच्छी तरह चल रहा है, उसमें ग्रोथ आ रही है. G is equal to 4% or 5% or 6%. And so there are two types of cash flows that you have to deal with. One is a discrete cash flow for each year, for which you will calculate the present values in the year that you're doing the valuation. And then you will take the constant rate of growth का जो perpetuity तक growth हो रही है. आपको 1 लाख रुपए मिल रहा है, मगर 1 लाख रुपए 4% ऐड होते जा रहा है हर साल perpetually. तो उसका नेट कैश फ्लो का क्या वैल्यू है आज की डेट में, उसको आपने इस फॉर्मूला में डाल दिया. सो दिस इज कॉल्ड द टू स्टेज मॉडल, अ डिस्क्रीट कैश फ्लो पीरियड एंड अ कांस्टेंट रेट ऑफ ग्रोथ कैश फ्लो पीरियड. Anybody having any difficulty with this, please try and ask me, please. You don't go into the formula. Fundamentally try and understand the concept, right? That there is a discrete cash flow for X number of periods, and then there is a fixed, and there is a fixed cash flow which is वो achieve हो चुका है, and उसका एक rate of growth हो रहा है 4%, 5% till perpetuity. तो उसका आपने present value calculate करना है. उस तरह आपको पूरा income value मिल गया. Right? Sorry. Okay. I'm saying that you have discrete cash flows for X number of years, year 1 to year X, right? You calculate the present value of each discrete cash flow in the year of the valuation. You get a present value of the cash flow that you have for X number of years, right? Discretely, each cash flow. This is one type of period, right? There is another period for which there is a constant rate of growth, and you achieved a steady cash flow with a constant rate of growth, and you have to compute the cash flow in the present on the valuation date. So there are two types of cash flows: discrete cash flows for X number of years, and then there is this thing, constant rate of growth of cash flows for the remaining period till perpetuity. That is called the two-stage model, and you have a way to compute the present values of this, and you can, it's based on the same principle, Gordon growth model or the present capitalization earnings method. You can calculate the present value of cash flows. Anybody with any questions, please feel free. Because after this, we'll be doing the discounted cash flows, which is another method for income valuation. Okay, so I have already explained all these concepts to you. I will now skip to the this is the terminal value, and the terminal value मैंने बताया आपको. Terminal value is वो cash flows की value होती है, which is the where the constant rate of growth has started. So is going up to perpetuity. So there are free cash flows at the rate of G growth, and discount rate is R. So a terminal value is free cash flow at the end of forecast period, 1 plus G upon R minus G, right? That's the terminal value equation, which is the same thing that I explained to you earlier. So here, this is an example of a 2-period this thing, which I've given you in the question answers also. So please try and do that, and you will be able to. So now the thing is that you have the entire business when you're doing this, you're basically the cash flows are being generated by the entire business. Now the entire business consists of all types of assets, tangible assets, intangible assets, land and building, plant and machinery, everything, right? Now, how do you get the value of the plant and machinery? So this example, if you look at the ABCD steps, it will tell you how you will get the valuation pertaining to which basically pertains to the plant and machinery. So you will basically get the land and building valuation separately, subtract it from the business, from the present values that you've achieved from there. Again, take off the intangible, assets ka jo valuation hai, that will be subtracted from there. The remaining will be your plant and machinery valuation. So this is how you generally do it. When you have group of valuers working together, it's much easier to apply this because you will be able to get the land and building valuation maybe by some other approach, and you'll be able to subtract it from the the business earnings value that you've achieved, you've calculated using this method, right? So you can get separately the plant and machinery valuation. Okay, so what is the weighted average cost of capital? So again, I was trying to tell you earlier that debt and equity have different expectation of returns, right? So suppose you have a 70+30 ratio between debt and equity. So debt is 70% and 30% is equity. So why do you need to know the cost of capital? Because there's an expectation of equity returns on equity. There's an expectation of returns on debt. Debt has, let's say, 8% rate of return expectation. Equity has, let's say, 12 or 13 or 14% rate of return. But only 30% of the capital is equity and 70% is debt. So you can basically calculate the weighted average cost of capital based on the proportion of debt and equity and the difference in the rate of return that equity and debt are expecting. So is there any problem with this understanding of weighted average cost of capital? Because this is again a fundamental understanding of the cost of capital to capital investments, right? An asset requires capital investments, right? So when you invested in a power plant, there was 70% debt, 30% equity. What is the cost of capital to them? There is an equity, there's a rate of return that the equity investors expect, and there is a rate of return that the debt agreement has stipulated. So the rate of returns both require. The weighted average of the two will give you the weighted average cost of capital of both the investments, debt as well as equity. Now there may be preference equity also, there may be other form of equity also. So you'll have to look at various forms of equity or debt. There may be various forms of debt also, right? So you will have to look at the cost of each this thing. So when you really do it in real life, you will have to compute the cost of capital to the investment based on the debt and equity. So to give you an idea of the rate of return expectation of by the investors in the invested capital, right? So any questions on this, sir?
It is.
So by weighted average cost of capital, we are calculating the net value of business.
No, you're not. You are basically, see, you have to use a discount factor to calculate the present values. Now, cost of capital is very close to the the discount the discounting rate for the present values. So the cost of capital is, in other words, the discount factor for the present values, right? So जो numerator में जो k आ रहा था denominators में पहले, that k could be the same as the weighted average cost of capital. So suppose a power plant is set up with 70%, 75% debt and equity. The cost of capital will give you the discounted rate of return that that you need to use in the denominator. Is it clear, sir?
Yes, clear.
Right. Good, sir. Okay. So again, the invested capital, I mean, this is again the same thing, that basically invested capital is used in investment of intangible assets, tangible assets, and working capital. And this is the sum total of the debt and equity. So that is the fundamental, this equation between the invested capital and the assets and the working capital, right? So now I'll come to the discounted cash flow method. Now, discounted cash flow method may basically what you do is that you assume that there is a fixed period, right? Say it's not perpetual. There's a fixed period, let's say 20 years or 25 years or 15 years, for which the asset is going to service, and the asset is giving you, the cash flows. You have the expected cash flows for the remaining life of the asset. And then there is this salvage value at the end, or let's say the terminal value of the asset that right? So that is coming to you right
You mean economic life, sir?
Yeah, this is the economic, correct, the economic life of the asset. So you have a terminal value which is coming right at the end of the period of 20 years or 25 years, whatever the economic life is. And there is a cash flow that you expect from 1 to 25th year, right? So you have a discounted cash flow method to basically compute the value of the income today, right? Value of all these incomes today, right? And we will see how, how you get, what cash flows do we consider, what do we not consider, and how we discount the cash flows each year with a discounting factor, which is the same as a weighted average cost of capital, let's say, or the the rate of return expectation, right? It's the same thing as that. So is this in this year perpetual? So capitalization earnings was based on a perpetual cash flow model, right? I mean, basically it's assumed that there is a constant perpetually IGA earnings, right? Which has very little error in that, because values of in perpetuity have very little value, right? At the end of, I mean, after 15-20 years. So that's why it's very in nutshell, it'll give you the almost the same result as a discounted cash flow method. So that is the premise on the way, the difference in the premises between the two methods. And in this, what we what we do is that we consider the entire. So there is an investment in the beginning that you're making, and there is a cash flow that is expected from the investments. So you are basically valuing the free cash flows in each year, right? So you will consider in this case, so you have the projected revenues, which may be based on past historical results, maybe based on some in-house projections, maybe based on some macroeconomic data, and then you have the raw material costs, which get reduced from the projected revenue because that's a cost that is being incurred. You get a gross margin after subtracting the raw material costs from the projected revenues. And then you have the operating expenses, which are all the manufacturing, expenses, the fuel, electricity, depreciation, sales and marketing costs, general and administrative costs. All of these are operating expenses. So these are also being reduced from the cash flow, the income that you, that the total income of each year, minus from the raw material. Raw material, you reduce the raw material cost, and you reduce the operating expenses. Now you get a gross margin, you reduce operating expenses from that, which is basically all the labor expenses, maintenance, all the, let's say in process industry, chemical, catalyst, electricity, fuel, depreciation, sales and marketing expenses, general and administrative expenses. All of these are called the operating expenses, right? And then when you reduce this, you get what is called the operating income, right? And this is the same thing as the earnings before interest, tax, depreciation, and interest. Basically, earnings before interest, tax, depreciation, and what is it?
Amortization.
Amortization. Sorry, amortization. Right. So yeah. EBITDA, basically, you get the EBITDA, but here, see, before in the last slide we had said that depreciation is reduced from this, but in free cash flows, basically depreciation is not being reduced. So it's basically, if you reduce it, then you add it back, right? You add it back so that you get the free cash flows, which is independent of depreciation. And then you also minus the future capital, future capital investments that are expected out of that are expected to maintain the income for those many years, right? So any future capital investment that is expected in the next, what a foreseeable future of the life of the asset, that is actually being reduced, and present value will be reduced from the present value of the income, that you compute, right? So this is being reduced in that period. So let's say that 50 lakhs was being invested in year 5. So that will be reduced from the year 5's income of free cash flows, right? Any working capital additions are also being reduced. or any working capital reductions are being added back to the free cash flows, right? So these working capital changes are accounted for in the free cash flows in the discounted cash flow method. So, so any new investments or assets that change the plan's design and the capital expenditure projection may require adjustments in the revenue and raw material projections. So there may be some increases or decreases in the, because of the new capital investment, there may be some increases in the operating expenses, or there may be some increases in the raw material expenses that may parallelly also happen. So you need to adjust for all of that, right? So when we say something like debt-free cash flows, in that interest and debt principal, repayment of debt principal is not taken into consideration, right? So only the debt, everything is taken into consideration, but the interest and the debt principal repayment is not taken into consideration. That is how we calculate. There are two ways to do it. One is a debt-free method, and the other is, by taking into account the repayment of debt principal and all that. So both methods can be used. Similarly, there can be a pre-tax calculation and there can be a post-tax calculation basis of, but then the denominator, the discounting factor will change, right? So discounting factor will also be parallelly adjusted based on the whether there are post-tax calculations or there are pre-tax calculations. So generally that is adjusted for the tax in the post-tax calculations, right? So generally the pre-tax discount rate is equal to after-tax discount rate divided by 1 minus composite income tax rate. That is a general, you adjust the discount rate based on whether you're taking the pre-tax income or you're taking the post-tax income. So some people, what they do is they like we had talked about terminal value in the previous example. So in here also some people, what they do is they reduce, because what happens is that if you try and create an expected cash flow for 20 years or 25 years, it's very difficult to do that. So you take it for the first 10 years, but then you take a certain you take a certain constant rate of growth after that, a cash flow with a certain rate of growth, and you compute the terminal value of that. So similar to that two-stage model that I had explained to you earlier, based on that, so there are discrete cash flows for 10 years, and then there are this constant rate of growth period for which you calculate the terminal cash flow value. So in this case, what you do is you reduce the discrete cash flow period to 10 years. And after that, you assume a certain constant income with the rate of growth till perpetuity, and you calculate the free cash flow, calculate the present value of that terminal, what is called the terminal value, right? So that is added to the discrete cash flows to calculate the present value. So this is generally the concept behind both capitalization earnings and discounted cash flow method. The problems with DCF and capitalization are just the converse of each other. In the discounting this thing, there are you're taking a discrete cash flow of many periods for which you may not which maybe may not be known that may be expected, but the accuracy of that is doubtful. So that is what is the problem with the discounted cash flow method. Therefore, people, when they use DCF, they use that with various scenarios. So sometimes they adjust the discounting factor. So you calculate numerous values. So you prepare a matrix in the end in which you take discounting factor to be 10% in one case, another case 11%, and you see the sensitivity with which the value changes. And again, so what it does is basically adjust for the higher risk, in the discounted cash flow method. So you prepare various types of scenarios. So sometimes you can take a higher rate of growth of income. Sometimes you can take a lesser rate of growth. You can take various combinations. Cost of raw materials can be changed if you expect the raw materials to behave in a different manner, then you can even change that. Uh, so, so the people do a lot of, let's say, based on certain scenarios, right? And then you prepare a matrix, and then you make an opinion. This will be the value, right? So you do a sort of a estimation of what you would consider as the best case valuation you can actually, or you can take a weightage of each one of these methods, and you can you know compute the valuation. Problem with capitalization is that it's assuming a perpetual model, and a growth rate is fixed, so it has its own problem, right? So these are being actually adjusted, as you say, in the two-stage model a little bit. You assume a constant rate of growth and a discrete cash flow model. And then you have a three-stage model also that we've not discussed, but it can have three different periods. So I've finished the income method. So I hope, I don't know whether I've been able to do justice or not, but I'm trying to do my best with.
Sir, you tried your best. Again, we have exposed to it for the first time. So we could not understand it well. So we will have to read it, and then likely we may trouble.
Yeah. I suspect that this may be to do with basic concepts like rate of return, basic concept like time value of money, cash flow, methodology, cash flow like value, calculating the present value of future cash flows. This is your basic problem right now, which you may have to address by reading up some notes on the income method.
And then some examples and calculations, we can understand it better.
Yeah, so in the I've given you some question answers, so I can share some examples from some notes that I have used. I can share that with you. You can look at those as the as the case examples also, right? I'll share those with you, right?
Sir, from exam side, how many questions are expected from this portion?
Boss, income method, I think Sandeep will be able to help you from your curriculum. I think the ratio of marks is given, I think, I don't know, the Sandeep would be able to tell you better. Sandeep, you have any idea as to how many marks this is income method is?
Okay, sir, we will find out from the curriculum.
It's there in the, I think it's there, and the breakup is there somewhere.
Yeah, he has given us the breakup.
Yeah. So that is the breakup that you will.
Cost approach 5.
And income
approach 2, sir.
Okay, so it's not going to impact you much, huh? That means.
Okay, still we have to understand, sir.
Yeah, it's yeah, but from the marks perspective, I'm saying, it's not going to. So after this, I think we are going to do, sales comparison method. So for which we have about 45 minutes left. So just give me a break for just 2 minutes, right? I'll be back in about 2 minutes. We will start the sales comparison.
Leasing of plant and machinery, sir.
That is tomorrow, sir. That is tomorrow. Leasing of plant machinery and broad categories of machines is tomorrow.
Leasing is in this lecture only, sir.
No. Leasing is tomorrow. 1 hour on leasing and 1 hour on broad categories of machines.
But in our timetable, it is given today.
So income method was done today in place of the income method tomorrow. So I decided to do.
Sir. No, sir. It is mentioned broad categories of machinery, leasing of plant and machinery. That is today. That is today, sir, not tomorrow.
Sir, I had mentioned very clearly, and Sandeep should be able to clarify this. I had mentioned very clearly that I will be doing income method today. I will take the cost income on one day, income on the second day, and then third day we will do broad categories of machines and leasing.
Sir, so there is an interchange of it, sir, in our program, written program. It's okay, sir.
Yeah. It's the same thing. Tomorrow we will be doing leasing and broad categories.
Right, sir. That's right.
Oh, okay. So we'll just take a break for just 5 minutes, and I'll be back. Okay.
Okay, sir.
Right. Please bear with me. Right. Is everyone there? I mean, can we start now? May I start, please? Okay.
Yes, sir.
Okay, so this is the third method of valuation. This is called the sales comparison method. Okay, it's also known as the market comparison method. This is basically the third of the, out of the three methods. We've done cost method, we've done income method. The third one is often the most reliable method, but difficult to apply in many circumstances, particularly for specialized assets. And this is called the sales comparison method, in which this is the cost, basically elements of how do you compare the subject asset, the asset which is being valued, with the asset which it is being compared with, and how do you derive from the sales comparison, how do you derive the value of the subject asset. And then where the limitations of the sales comparison method we will do in the end. So basically in this case, what is being done here is that you're taking the comparison of sales of assets, of similar assets or identical or similar assets. Okay, and you're seeing how you're going to compare it with the subject asset's value, right? So you have an asset A which is available from, let's say, a manufacturer, and you also know the comparison, the sales value, the value of the sales, the price at which it was sold in the market, let's say 6 months back or 1 year back, and you are, you're almost, this is almost the identical asset, but there will be some fundamental differences which you'll have to see. What were these? Firstly, that it happened 1 year back, right? And how you'll also have to see, okay, how old was the asset that was sold? Was it 10 years old compared to the subject asset that may be 5 years old? It may have a slightly different, features, maybe something to do with the capacity of manufacturing, something to do with some adjustment that you may need to make, and we will look at what are the possibilities there. So the sales comparison approach basically is you're trying to get as much of a similar asset as possible within the same time frame that you're trying to value, right, as much as possible, right? And you're looking at some data which is available to you from the market, which is giving you an indication of the value of the asset. So obviously this is the most reliable method because it was sold at that price just around the time that you're valuing. So it gives you a very reliable value of the asset, which is currently already tested in the market, right? So all you have to see is that make some adjustment in terms of what is the difference between, some minor difference between the subject asset and that, maybe in the brand, maybe in the warranty of the product, maybe in the whether it was installed or not, or whether it was off the shelf and your asset is installed, so maybe that difference. So there could be n number of differences that you need to figure out what they are, right? So this is obviously the most reliable method, but what it needs is, it needs an active market, right? For you to, so if the market is not active, if the buyers and sellers are not, like, they're not very active in the market, and one sale is happening, let's say in 2 years, then that is not a good scenario to be doing a sales comparison of, So there may be a question mark to that kind of a sale comparison, because when there are n number of transactions, that is the best reliable sales comparison. That's the time when you can really use a sales comparison. When there are at least a few reliable transactions that you can rely upon as the value of the asset. So yeah, the other thing is that buyer and the seller were not related to each other, and they were independent, they were acting rationally and all that, and that is important. They should not be like groups, companies of the same group, for instance. That may not be a good sales comparison method, because they may have made it may not be treated as an arm's length transaction. So in that case, it's not really a very good example. So there will be some exceptions of that. So you need to rule that out before you take that example as a sales comparison value. So this can be applied to either a group of assets or specialized assets, but generally it is very difficult to apply it to specialized assets. Like as I told you, for example, power plants, for instance, or process plants, those may have some very great number of differences which may not be possible for you to adjust. So that will make the comparison. So it's generally applied to more like individual assets, things like cars, things like individual machines of similar capacity. Those are the things that you'll normally apply these sales comparison method to. Very difficult to apply to specialized assets, where the number of transactions that may have taken place in sales may be very few for you to rely on to compute the value reliably. So what are some of the factors which you'll consider when comparing it with a subject asset? So you will see the effective age, the condition, the capacity, the location, the size of the machine, the date of sale. Sometimes there can be circumstances of sale, like as is where is condition. Then there will be whether it needs, where is installed, it needs environmental compliance, safety compliance. So those kind of adjustments, some may be difficult to adjust also. In some cases maybe even difficult to adjust. So these are some of the criteria that you have have to bear in mind, that the subject asset is 20 years old, but that is 10 years old, right? So this is what the sales comparison would normally ask. I mean, there may be factors that you'll have to consider for adjustment in the. So let's say that you are comparing an asset which is 5 years old to the subject asset which is basically 10 years old, right? So you will have to adjust for the depreciation of the of the 5-year comparable transaction that you're talking about. So you'll have to adjust for the 5 years excess of depreciation to be able to bring it at par with the value that you are aiming to achieve. So with the correct value that you're aiming to achieve, right? So unless you adjust for the excess number of years which is being used in the subject asset, you may not get the right result, right? So there can be some small differences in capacity. There can be differences in location, for instance, that may, I think by location they generally mean changes in the tax component, etc. So that may be a reason for you to see the criteria that you may have to see. Then manufacturer, suppose the manufacturer is has a higher quality as compared to manufacturer B, then you will make some adjustment on the basis of that, right? Like yesterday we were talking about BHEL versus Chinese, so plant machinery as in the case of a power plant. So those can be reasons for you to look at. Now motivation of parties. So by this I think it means that liquidation, for instance. Liquidation is a scenario in which that may change the motivation of the seller, right? The seller may have a very time bound in which he has to sell, right? So there is a distress. There's a distress on the owner that needs to be considered. So whether it's a wholesale price or a retail price, whether it's an installed price or a non-installed price, time of sales, meaning seasonal, I suppose it's to do with seasonal, or let's say the year of sale that you have to adjust for, So maybe the sale happened the previous year and not this year that you're talking about. So in that sense, you have to account for the time of sales as well. The type of sale, I think, is again to do with whether it's retail selling, or it's a wholesale selling, or it's a auction selling, or it's a private sale. So those kind of things that you have to bear in mind and adjust accordingly, right? So auction prices may fetch a higher price as compared to a private sale, right? So that sense, auction prices are also considered to be better than the private sale. So these are some of the adjustments that you will have to look at when you're comparing subject asset with the sales comparison, sales of another asset which is comparable, right? So these are some of the criteria that you will keep in mind. Now, so when there is a complete identicality. I mean, they're completely identical. Then there is a direct match, and it's easier to do a sales comparison than making all those adjustments. The other could be that there is a difference in the size and capacity, etc., which you need to adjust for. So there is a 100-liter machine versus a 200-liter machine that you may have to buy, right? So you will make the adjustment based on that. So the third method is the technique is the ratio between the selling price and the current cost new of property. So this is the third technique in which you take the selling price of an asset as as an indicator of the current cost new of the property, and then you will treat that as and you can take a percentage of that cost. Suppose the installation is not there, for instance, right? So you subtract the installation out of it, right? Or you will say that the foundation is not there, and the foundation will be subtracted out of it. So you'll take a percentage of cost out of the sale price to adjust for that shortcoming, or let's say difference in the comparison. So again,
kind of last point, if you can.
Yeah, so by percentage of cost, it means that you have as I told you, I mean, there can be a asset A which is you've taken the price of a off-the-shelf machine A, but you are supposed to value machine B which is installed, machine A which is installed, right? So the selling price of that machine A which is off the shelf, so you will add a percentage of cost to that which is towards installation, right? So that is the percentage of cost basis of a machine. Or you take off the foundation, for instance, or you'll add the foundation based on what the comparable, difference between the subject asset and the comparable asset is. So suppose you're valuing the machine with its foundation, right? So you will obviously have to add the value of the foundation also, right? So you will add to the sales price, right? So that is called the percentage of cost method.
Okay.
Now, again, this is again about specialized assets and all that. So generally, sales comparison of, again, it reiterates that sales comparison of installed assets, a large group of assets, plants, complete process plants, etc., is very difficult. So that is what it's trying to bring out here, that there are certain classes of plant and equipment that are homogeneous, which are easy for you to, office equipment, motor vehicles, some industrial machinery. These are easy for you to use a sales comparison method in. But if you look at the entire power plant, it'll have a lot of changes in a complete refinery plant of some kind. You may be talking about completely different situations. So you may not be you may not be doing the right thing by comparing it apple to apple. So what is the procedure for this? Basically, gather data on sales and offerings of similar properties. You will do the comparability to the subject property, and you will basically evaluate the units of comparison, etc. And you will analyze and adjust the comparable data and apply the results to the subject. So this is basically just the procedure. but broadly you will, just to understand, you'll have to make some adjustments for the unlikeness of the two assets that you are have to value. I mean, there may be some dissimilarities in anything, capacities, size, uh, as we considered all those factors earlier, right? So this is broadly the concept about sales comparison. This is basically people rely on a lot of data. Some people rely on export-import data for sales comparison. Some people use some published data for sales, that may be available. To be honest, even large plants you use sales comparison sometimes, but you use it at the business level also. I mean, you look at two power plants being compared. You look at the entire business of a power plant being sold, and you compare it with a power plant sometimes. But it would be theoretically incorrect to do that if unless the situation is really comparable between the two. Suppose they have the same type of technology, they have the same type of power load factors, the same type of age and etc. Then you may consider sales comparison. Otherwise, you will avoid doing the sales comparison between between group of assets, or let's say process plants and large plants, right? So this is a very small sort of presentation of the sales comparison method. So if you have any questions on this, you may ask me, and then we can go back to one of the income method examples. I think you may want to spend some time on an income method example to be able to
understand it.
Yes. So on sales comparison, if you have any questions, you please ask.
So do we use sales comparison normally for
Yes.
regular valuation in the practical example?
Yeah. See, in India, the problem is that there's not much published data available. The problem with India is this, that there's not much published data available. So you generally rely on the quotations of the suppliers, right? But that's not a sales comparison, right? Sales comparison is a actual sale that has happened between a buyer and a seller, right? So cost method is easy. Sales comparison is a little difficult unless you have a good database of sales comparable. Cars, I mean, for cars, it's very easy, right? Motor vehicles, very easy to get it, right? Office equipment, again, you can do, but doubtful. I mean, then import and export, machinery data may give you a lot of data. That is possible. That is another source of data that is available. But other than that, I have not personally come across any database in India which is of such a huge sort of nature that you can rely on it to be able to, get. So it depends really on the database that you get hold of. If you get a good database of transactions, you're fortunate to get that, then obviously you will, be able to benefit out of that.
Sir, I have a question here. I
Yes.
mean, like yesterday also, we have discussed about the BHL and the BHL and Chinese collar.
Correct.
Now, we have seen cost approach. We have seen the
Right.
the income method and now sales comparison also.
So,
like for example, like few power plants whose PLF is quite high. I mean, it is a Chinese plant, but still the PLF is running in over 100% or something. A PPA is also very high.
Yeah.
But again, it is a Chinese plant. Okay, so its cost value probably will be maybe less lower than the other one.
Maybe income value, right? Correct. Yes, correct.
So then while valuing how we will give that factorization, because probably by income method, then probably that Chinese unit will be valued more, probably higher than the other one.
Yeah, because see, the thing is that now when you're taking a power plant, you're basically taking the entire business, right? You're valuing the entire business. You're valuing all the intangibles also, all the licenses, all the permits, all the coal agreements, coal availability agreements.
PPE also to be considered.
Yeah, correct.
So that's why you cannot compare like that.
No,
Based on PPE,
So let me just try and fully complete it. So I'm saying that you're basically valuing all of these things also, intangibles, the licenses, the permits, the business, the PPAs that are in hand, right? So
yeah.
So basically, you're not valuing only the Chinese equipment, right? Remember that when you're doing the business valuation using the discount cash flows, you're getting the value of the entire business, because it's very difficult for you to separate the Chinese equipment ka kya value hai na. So it's very difficult to get that. So what you'll have to do is see, for instance, in my case, what we did is there's this colleague of mine doing a land and building valuation. I am doing the plant machinery valuation. Then I'm also using an income method. There is a financial valuer also using the income method, together with me. So the income method will give you the entire business value of the plant, the business value of the plant, right? In terms of the discount cash flow. So mera income method se aaya, let's say I've got 2,000 crores as the value. Then I have plant machinery, let's say at 1,800 crores, and I have land and building at 500 crores, and I have security financial valuation of all the financial assets, all the debtors and all the advances given and all that. That is, let's say, 200 crores. So I get a value of 2,500 if I use a sum of parts valuation, right? If I sum up plant and machinery, land and building, and the financial value, I get a value of 2,500 crores. But the entire business was only 2,000 crores, which I computed using the income method, right?
Okay.
So I will then prefer to use the income method, because the income method is provided that you have a reliability on the discounted cash flows, right? Subject to the reliability of the discounted cash flows. Now, sometimes it's very difficult, right? Because you may have a 10-year PPA, you may have a 5-year PPA, you may have a 20-year PPA. So even the expectation is a bit, risky, right? You may forecast cash flows which may not scan the scrutiny of the future, right? So you may want to use a higher rate of return. You may like to use a little higher discount factor to be able to adjust for those risks, right? Or you may calculate scenarios that look, okay, what happens if my cash flow of this PPA stops after 5 years, right? And I have to go to sell the bijli in the market. I sell it in the market at the market rate, which is much lower than the power purchase agreement. So then I will adjust for that. So, and then when I'm doing the plant and machinery valuation, remember, I will also discount all the functional obsolescence and economic obsolescence, of which I will also take into consideration, any economic factors that I have to. So finally, somewhere there has to be some convergence in these values, So a good valuation is when there is some convergence, right? If there's a huge disparity between the two, then obviously there is some disharmony between the methods, and you may not have done the full piece of work, let's say fully understood the thing, and it is tough. I'm not saying it's easy, right? And there is no final answer. Each situation demands every complexity to be accounted for, right? So let's just try and do this quick calculation using the income method. If there is if we can, let's try and do this so that we get a better handle of the income method, because people are facing some problem using this income method. So I might as well spend some time. So, go to this example. You can ask questions in the meanwhile while I put up this thing. If you have any questions, you can quickly answer, but otherwise, just see this question. If you look at this particular question, This is also there in the list of questions that I've given you. This is also in part of my slides. So here, what I'm asking you to do is that there's a free cash flow of an organization from year 1 to 6 are 1 crore from year 1 to 3, and then 2 crore from year 3 to 5, and 3 crore in the year 6. The entity is assumed to have an annual growth rate of 8%, and the discounting factor applicable to the entity is 12%. Please find the terminal value of the entity beyond the organization period, right? So what you have
the slide is not projected.
Oh, I'm sorry. One second. I'm so sorry. One second. One second. So you got it now? Can you see it? Can you see it now?
It has come.
Yeah.
It has come.
So the question is asking you, what is the terminal value of the cash flows at the end of the organization, beyond the organization period of 6 years, right? So you need to calculate the terminal value, right? And look at the formula above. The terminal value at the end of the forecast period is 1 plus G upon R minus G, right? Okay, so free cash flow multiplied by 1 plus G upon R minus G. So at the end of the year 6, 3 crores is the cash flow in the year 6. Now in the year 7, the cash flow is going to be, so it's asking what is the terminal value of the cash flow subsequent to the year 6. So you have 3 crore in the base year, right? So 3 crore into 1 plus G upon R minus G, right? 3 crore into 1 plus G upon R minus G is the formula for your terminal value. So 1 plus G, the rate of growth is 8%, so 1.08 divided by R minus G, which is 12% minus 8%, which is 4%. So you take 100 to the numerator, so it's basically 3 crores into 100 into 1 plus G upon 4, right? So that is 3 crores into 1 plus G, which is 1.08 into 100 upon 4. That is the terminal value of the cash flows in the that's the terminal value of the cash flows. That is what you will be calculating as the terminal value. So if anybody has not understood this,
please repeat, sir.
Sorry?
Once again, sir.
So the terminal value is the free cash flow at the end of the period, at the end of the forecast period, into 1 plus G upon R minus G, right? So it is equal to 3.24 in the numerator into 100, which is 324 divided by 4, and that is equal to 81 crores. That is the value of the free cash flows at the end of the. So you see, what was the base period cash flow? It is 3 crores in the year 6, and the growth is 8%. So it is 1.08 in the numerator and 4% in the denominator. So you can convert percentage into number. So you get 4 in the denominator and 100 in the numerator. So I'm sorry, I don't have a whiteboard. So otherwise, this is it. 3 crores into 1.08 into 100 upon 4. So 81 crores is the free cash flow into perpetuity. I mean, terminal value of cash flows until perpetuity of this organization. The terminal value, right? Did you people get it? Any questions on this? In this calculation? Now, further, you can also be asked. Sorry?
It is okay, sir.
Yeah. So further, you can also be asked as to what is the present value of these cash flows, right? So in the year 1, you have 1 crore until 3 years. So 1 upon, the period is the first year. So it's 1 plus R. So like that, you can calculate the net present value of the cash flows in each year. For calculating the value of the discrete cash flows, the present value, you can get it from the basis of calculating the present value of these discrete cash flows up until year 6. So then you get the present value of the cash flows, and then the terminal value is in the year 6. So you can discount it by 1 plus R raised to the power of 6, and then you will get the present value of the terminal value also. So you can calculate the value of the organization, the business. So you can try this. There are a few other questions in the questions and answers that I've given in my question and answer. This thing, I'll just open it if you want. We have 8 more minutes. We can try and do this. I had mailed it to, has it been shared with you people, that question answers on income method? Okay,
Not yet, sir.
Not yet, okay. It will be shared with you. 1 second, let me just see if I can quickly download it and I can share it with you people. Yes, sir. So an equity investment is being made with a constant expected growth in net cash flow. 3 assumptions are: the normalized net cash flow in the period 1 is expected to be 100. The cost of capital is 13%. The sustainable rate of long-term growth is 5%. So what is the present value using capitalized earnings method? So can somebody do it? Can somebody try and do this question? Somebody should try and take a shot at this. No, I explained to you the capitalized earnings method. It's a very simple answer. It's income upon the capitalization rate. You just have to compute the capitalization rate. What is the capitalization rate here? The cost of capital is 13%. Rate of long-term growth in net cash flow is 5%. What is the capitalization rate? First, tell me that. So can anybody tell me what is the capitalization rate here?
18%.
No, sir. I told you the cost of capital here is 13%, or let's say the discount rate is 30%, the same as the discount rate. Cost of capital is the same as discount rate, 13%. Growth is, G is 5%. What is the capitalization rate? Let's go back to the slide, sir. Let's go back to the slides, please. So if you look at my slide here, what did I tell you? The capitalization rate is equal to discount rate minus rate of growth, right? I did tell you, right? The discount rate minus rate of growth is the, if you looked at my slide number 8, capitalization rate is discount rate minus projected growth of earnings to be capitalized, right? So
Yes.
K minus G.
yeah, so K minus G, and that is 13 minus 5, 8%, right? So 100 divided by 8%, what is that? So that's the value of your investment. It's very simple, sir. It's very simple, please.
0.125.
1,202.
Sorry?
1,202.
Yes, exactly. It's 100 upon 0.08, which is 1250, right? Now, suppose the base year, instead of the base year, you said instead of the nominalized, instead of the period 1, suppose this thing is 100 in the base year, then what will be it? I told you the method, right? If you take the base year, then you add the growth in the first year to calculate the period 1. 100 into 1 plus G. So the rate of growth here is 5%. So 1.05 in the numerator into 100 upon 0.08. So it comes to 1312.50. Right, sir? Is this also okay, or is this not okay? You are just the period of the period for which you're assuming the net cash flow is changing. On the year period 1, you are changing it to 0 year. So then you take the rate of growth also for the period 1 and apply the same formula. So you just compute the numerator becomes 100 into 1 plus G. Okay, so I think you guys need to go over my slides again, read something on the income method, and try and get a handle of what capitalization earnings is about, and also discounted cash flows. Maybe I've given you a simple example of that, a simple question on that also. You see, you can possibly be able to, I'll share some more notes with you people, not to worry, okay? It is not that difficult. You just have to understand the time value of money, concepts about rate of return, discount factors, cost of capital, just simple things like that. You'll be able to get this very quickly. So I think I have to close here. It's 4:30. And next class, I think, will be starting, right?
Yes.
Sandeep, can I close, or do we?
Yes, sir. Yeah. Absolutely. We can just conclude this session over here, sir. It's already 4:30.
Okay, you have